In today's video, we are doing a deep dive into real estate accounting, covering the complete business flow, end-to-end accounting treatment, real-world journal entries, financial statement impact, common errors, and the kind of interview questions that companies actually ask. Whether you are preparing for a job interview, working in finance, or just building your accounting foundation, stay with us because this video covers everything. In this section, we will go through all the key concepts of business understanding in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Real estate involves buying, selling, and leasing properties. It's a trillion-dollar industry globally with major players like Godrej Properties in India. Understanding the dynamics of this sector is key to grasping its accounting complexities. Godrej Properties generates revenue through residential and commercial projects. Costs include land acquisition, construction, and marketing. Understanding these revenue streams and cost drivers helps in accurate financial analysis. In real estate, the finance, operations, procurement, and legal departments are vital. Finance manages budgets, operations oversees project execution, procurement handles vendor contracts, legal ensures compliance. Each plays a role in accurate accounting. In real estate, work flows from project initiation to completion. This includes land acquisition, design, construction, sales, and post-sales services. Each step involves specific accounting tasks, ensuring accurate financial tracking. Stakeholders include clients, vendors, government, banks, and regulators. Each affects accounting. Clients impact revenue recognition, vendors influence cost accounting, and regulators ensure compliance. Understanding these relationships aids accurate financial reporting. Real estate faces challenges like complex contracts, long working capital cycles, and stringent regulations. These require precise accounting to manage risks and ensure compliance, crucial for maintaining financial health. Real estate accounting is unique due to large-scale transactions, long project timelines, and regulatory intricacies. It requires specialized knowledge to manage these complexities and ensure accurate financial reporting. In real estate, the accounting team, triggered by events like sales closures or project milestones, records entries. This ensures financial data reflects the company's current status, aiding decision-making and regulatory compliance. In this section, we will go through all the key concepts of end-to-end process in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. In real estate, the process begins with project initiation and tendering. This involves identifying new projects and inviting bids from contractors. The project management team at Godrej Properties handles this. They prepare tender documents outlining project specifications and expectations. This step creates a potential future liability as it commits the company to a project. Errors here, like incorrect project scope, can lead to costly project overruns. Next is evaluating and approving bids, which is crucial for choosing the right contractor. The procurement team evaluates bids based on cost, quality, and timeline. They use evaluation documents and software systems to compare proposals. An incorrect evaluation can result in selecting a contractor who cannot deliver, affecting the project's success. The approval of a bid leads to a contractual obligation and potential future expense for Godrej Properties. After bid approval, contracts are signed and advance payments may be issued. Legal and finance departments manage this, ensuring all terms are clear and legally binding. They use contract management software and accounting systems. Accounting records these as advance payments, a type of prepaid expense. Misinterpretations can occur if contract terms are unclear, leading to disputes and financial loss. Work then commences, managed by the project management team. They oversee the project's progress through regular site inspections and progress reports. Systems like ERP software track work in progress, WIP. This phase affects financial statements as costs accumulate under WIP, potentially impacting profitability if mismanaged. Delays or quality issues at this stage could lead to increased costs and project timeline extensions. Upon completion, the project undergoes a handover process. Quality assurance teams inspect the final product to ensure it meets specifications. Handover documents and certificates are crucial at this stage. This transition marks the shift from work in progress to a completed asset. Mismanagement here can lead to client dissatisfaction or legal issues if the property fails to meet expected standards. After handover, invoicing and payment collection are managed by the finance team. They generate invoices based on contract terms using accounting software. This step creates accounts receivable, reflecting money owed to the company. Delayed invoicing or errors can affect cash flow and financial stability. Ensuring timely and accurate billing is critical for maintaining healthy financial operations. The final step is reconciliation and project closure, where accounts are reviewed to ensure all transactions are recorded correctly. The finance team matches invoices and payments, adjusting any discrepancies. This ensures accurate financial reporting, crucial for compliance and strategic planning. Errors in reconciliation can lead to financial inaccuracies, affecting decision-making and stakeholder trust. To summarize, the accounting flow in a real estate project includes multiple critical steps from tendering to project closure. This flow ensures each phase's financial transactions are accurately recorded, supporting effective management of resources. Understanding this flow helps in maintaining project timelines and financial health, ensuring Godrej Properties can deliver successful projects consistently. In this section, we will go through all the key concepts of accounting concepts in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Revenue recognition revolves around determining the exact timing and manner of recording revenue. This is particularly significant in real estate because projects often span multiple years. Indian Accounting Standard 115, Revenue from Contracts with Customers, guides this process, ensuring revenue is recognized as performance obligations are met. For example, Godrej Properties must recognize revenue as different phases of a housing project are completed. Unlike other industries with immediate delivery, real estate involves phased, long-term work, making this concept vital. Inventory valuation in real estate deals with assessing the value of properties held for sale. It's critical because property values can fluctuate significantly over time. Indian Accounting Standard 2, Inventories, directs companies to value inventory at the lower of cost and net realizable value. For instance, Godrej Properties must evaluate if a project's selling price has dipped below its cost due to market changes. Unlike inventory in retail, real estate inventory can include incomplete properties, adding complexity. Fixed assets and depreciation involve calculating the decline in value of real estate assets over time. It's important for real estate firms because buildings and infrastructure require specific depreciation methods. Indian Accounting Standard 16, Property, Plant, and Equipment, stipulates depreciating assets based on useful life and depreciation method. For example, Godrej Properties might use the straight-line method for office buildings, ensuring costs are accurately matched to periods. Real estate assets differ, as they often appreciate, unlike typical depreciating assets. Lease accounting deals with recording and managing lease agreements. In real estate, this is crucial because many companies lease properties rather than owning them outright. Indian Accounting Standard 116, Leases, requires recognizing both assets and liabilities for lease agreements, affecting balance sheets directly. For example, Godrej Properties leasing office space must record a right-of-use asset and lease liability. Unlike general leases, real estate leases often involve significant values and long durations, complicating accounting. Contract accounting and work in progress focus on managing the financial aspects of incomplete projects. In real estate, this is crucial as many projects are ongoing and span extended periods. Indian Accounting Standard 11, Construction Contracts, mandates recognizing revenue and costs in line with project progress. For instance, Godrej Properties records revenue throughout the construction phases of a new development. Unlike industries with finished goods, real estate deals with ongoing work, requiring detailed tracking of progress and costs. Provisions and contingencies involve accounting for potential future liabilities or losses. This is particularly important in real estate, where construction risks and legal disputes can lead to unforeseen costs. Indian Accounting Standard 37, Provisions, Contingent Liabilities and Contingent Assets, requires recognizing provisions when it is probable that outflows will occur and can be estimated reliably. For instance, Godrej Properties might need to set aside funds for potential legal settlements. Unlike other industries, real estate often faces unique, large-scale risks, demanding careful financial planning. Deferred revenue addresses situations where payment is received before services are delivered. This is common in real estate, where clients may prepay for properties under construction. Indian Accounting Standard 115, which also governs revenue recognition, dictates that revenue should only be recognized once the associated performance obligations are met. For example, Godrej Properties collects prepayments but recognizes revenue only upon project completion. Real estate's long project timelines make managing deferred revenue crucial, unlike industries with immediate deliverables. Cost allocation involves distributing shared costs across different projects or departments. This is crucial in real estate because resources like labor and materials are often shared among multiple developments. While no specific accounting standard dictates cost allocation methods, companies like Godrej Properties use internal policies to ensure fair distribution. Accurate cost allocation is essential for analyzing project profitability and making informed business decisions. Real estate's large-scale projects and shared resources make cost allocation more complex than in many other industries. Segment reporting provides financial transparency by reporting data according to business segments, such as residential and commercial real estate. This is vital in real estate to highlight the performance of diverse operations. Indian Accounting Standard 108, Operating Segments, outlines requirements for disclosing segment information to aid stakeholders' understanding. For instance, Godrej Properties must report separately on its residential and commercial ventures. This differentiation is more pronounced in real estate, where operations can vary significantly in size and scope compared to other industries. In this section, we will go through all the key concepts of journal entries in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Capital injection is crucial for a new company as it provides the necessary funds to start operations. By crediting the equity share capital, we acknowledge the ownership interest of investors, while debiting the bank account reflects the actual cash inflow. This foundational step ensures that the company has adequate resources for its initial expenses and investments, setting the stage for further business activities. Acquiring land is a significant initial step for a real estate company as it forms the basis for future development projects. By debiting the land account, we increase the asset base of the company, while the credit to bank reflects the outflow of cash. This transaction is crucial as it transforms liquid assets into fixed assets, which will be developed to generate future revenue. Purchasing construction materials is a key part of the operational phase for a real estate company. By debiting inventory, we recognize the increase in company resources that will be used to create value. The credit to accounts payable acknowledges the liabilities incurred, evidencing the company's obligation to pay its suppliers. Such transactions reflect the strategic use of credit to finance operations without immediate cash outlay. As construction progresses, materials are utilized, transforming them into a work in progress. This phase involves transferring costs from inventory to work in progress, reflecting the value addition in real estate development. The debit to work in progress signifies ongoing construction efforts, while the credit to inventory reduces resources available. Accurately tracking these changes is vital for cost management and project valuation in real estate. Recognizing revenue is a pivotal moment for any business, reflecting the culmination of previous efforts. Here, the sale of property units results in accounts receivable, capturing the amount owed by customers. By crediting revenue, the company records its income, impacting profitability. This transaction highlights the real estate cycle, where constructed assets are sold, generating crucial cash flow and justifying previous investments. Collecting receivables is crucial, turning potential income into actual cash flow, vital for sustaining operations. Debiting the bank account increases liquidity, while crediting accounts receivable reduces outstanding amounts due. This transaction underscores the importance of effective receivables management in maintaining a healthy cash flow, enabling the company to meet its financial obligations and support future investments. Paying suppliers demonstrates the company's commitment to meeting its obligations, fostering strong business relationships. Debiting accounts payable reduces liabilities, reflecting payment of debts, while crediting the bank account acknowledges the cash outflow. This transaction is essential for maintaining the company's creditworthiness, ensuring ongoing access to materials and services needed for continued operations and growth. Depreciation reflects the allocation of an asset's cost over its useful life, accounting for wear and tear. By debiting depreciation expense, the company recognizes this cost, impacting profitability. Crediting accumulated depreciation reduces the asset's book value on the balance sheet. This process is crucial for accurate financial reporting, ensuring that asset values reflect economic reality and aiding in strategic decision-making regarding asset management. Year-end closing consolidates a company's financial activities, summarizing performance. By closing revenue and expense accounts into income summary, the company evaluates its profitability. Transferring net income to retained earnings strengthens the equity base, reflecting accumulated profits available for future use. This process ensures accurate financial reporting, providing insights into the company's operational success and guiding strategic planning. In this section, we will go through all the key concepts of financial statement impact in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Current assets in real estate like Godrej Properties include cash, accounts receivable, and inventory. An increase in cash results from sales or financing, boosting liquidity. Higher accounts receivable may indicate strong sales, but also reflect delayed payments. Inventory rises with ongoing projects, signaling growth, but also potential holding costs. Monitoring these is crucial for managing liquidity and operational efficiency. Non-current assets like property and equipment are vital, as they underpin revenue generation in real estate. In Godrej Properties, investments in these assets drive future income, but also tie up capital. Equity reflects ownership funding. Increasing equity strengthens financial stability and creditworthiness. Balancing between asset investments and equity ensures sustainable growth and capital efficiency. Revenue generation is central for real estate firms like Godrej Properties. It reflects sales of properties and leasing activities. Rising revenue indicates robust market demand and successful sales strategies. However, direct costs such as cost of goods sold increase with higher sales, impacting gross profit. Managing these costs efficiently is essential to maximize profitability and sustain competitive advantage. In real estate, indirect expenses such as administrative and selling costs can erode profitability. For Godrej Properties, managing these expenses is crucial for maintaining EBITDA, which signals operational efficiency. Profit before tax, PBT, offers insight into financial health before taxation, highlighting net operational success. Keeping indirect costs in check ensures sustained profitability and healthy financial performance. Cash flow is vital for real estate companies like Godrej Properties. Operating cash flow measures liquidity from core operations, indicating financial health. Investing cash flow shows capital allocation in assets, impacting future growth. Financing cash flow reflects borrowing and equity activities, shaping the firm's capital structure. Balancing these cash flows ensures liquidity, funds growth, and optimizes financial strategy. Key financial ratios provide critical insight into a real estate firm's performance. The current ratio assesses liquidity, essential for meeting short-term obligations. A healthy debt-to-equity ratio in Godrej Properties indicates balanced financial leverage. ROA evaluates how effectively assets generate profit, while the net profit margin reflects overall profitability. These ratios guide investors and management in strategic decision-making and financial health assessment. In real estate accounting, like at Godrej Properties, specific errors can significantly impact financial reporting. This section will delve into common mistakes found during audits, pitfalls during interviews, and errors in ERP systems. Understanding these errors helps in preparing accurate financial statements and ensures compliance with accounting standards. Let's explore these errors in detail to help you avoid costly mistakes and maintain the integrity of your financial reports. Misclassifying expenses as capital expenditures is a common error in real estate firms like Godrej Properties. This occurs when costs meant for immediate expense recognition are incorrectly capitalized, inflating asset values. Such errors stem from a lack of understanding of capitalization criteria. The correct approach involves reclassifying these expenses, reducing net income, but reflecting a more accurate financial position. Auditors detect this by reviewing invoices and comparing them against capital expenditure policies, ensuring the integrity of financial statements. During interviews, candidates might overstate property values by ignoring recent market declines or relying on outdated data. Such misstatements can lead to unrealistic company valuations, impacting strategic decisions and investor perceptions. Accurate property valuation requires using current market trends and comparable sales data. Interviewers at Godrej Properties might probe candidates' understanding of valuation techniques and market analysis to ensure they grasp the importance of realistic appraisals. Proper valuation practices keep financial statements reliable and informative. Inaccurate data entry in ERP systems is a prevalent error in real estate accounting, affecting companies like Godrej Properties. These errors often arise from manual entry mistakes, leading to discrepancies in financial reports. Correcting these involves cross-referencing entries with original documentation, ensuring all data aligns with actual transactions. This process not only rectifies errors, but enhances the reliability of financial statements. Regular audits and automated checks in ERP systems can further mitigate these risks, promoting data accuracy and consistency. Cutoff errors in revenue recognition occur when revenue is recorded in the wrong accounting period, a common issue in real estate transactions at firms like Godrej Properties. These errors disrupt the accuracy of the income statement, either inflating or deflating profits. The root of this problem often lies in misunderstanding the matching principle. Correcting involves adjusting entries to ensure revenue reflects the period it was truly earned. Auditors typically uncover these errors by examining contracts and transaction dates, ensuring compliance with accounting standards. Standard switching errors occur when real estate companies like Godrej Properties confuse international financial reporting standards with local generally accepted accounting principles, leading to inconsistencies in financial reporting. This confusion often arises from a lack of expertise in the specific requirements of each standard. It results in financial statements that may not comply with regulatory expectations. To correct this, companies must restate financials according to the correct standards. Auditors identify such discrepancies by reviewing policy documents and ensuring alignment with the appropriate accounting framework. In this section, we will go through all the key concepts of interview questions in detail, with practical examples and real-world context, so you gain complete clarity on each aspect covered here. Indian Accounting Standard 115, Revenue from Contracts with Customers, requires recognizing revenue when performance obligations are met. For real estate, it means recognizing revenue over time as construction progresses, not just at project completion. This impacts cash flow projections and financial reporting, providing a more accurate reflection of ongoing project revenues. For Godrej Properties, this could alter how they report earnings and manage financial performance expectations. When Godrej Properties sells a completed property, the journal entry involves debiting cash bank and crediting revenue from property sales. Additionally, you debit cost of goods sold for the construction cost and credit inventory. This reflects the revenue recognition and the reduction in inventory, accurately portraying financial performance and asset reallocation. Such entries ensure the balance sheet and income statement reflect the transaction's impact. ERP systems centralize financial data, streamline processes, and enhance project management. For Godrej Properties, this means improved accuracy in tracking project costs, revenues, and timelines. ERP systems facilitate real-time insights and compliance with accounting standards, helping manage complex portfolios and financial reporting. They enable efficient handling of large data sets, which is critical in real estate for strategic decision-making and maintaining competitive advantage. Cost recognition in real estate is tricky due to long project timelines and fluctuating costs. Matching costs with revenues is essential for accurate financial reporting. Delays in construction or unexpected expenses can disrupt this balance, affecting earnings reports. Real estate firms like Godrej Properties must carefully estimate costs and update them as projects progress to ensure financial statements reflect true performance, balancing investor expectations and regulatory compliance. International Financial Reporting Standards 16 changes lease accounting by requiring lessees to recognize assets and liabilities for all leases, impacting balance sheets. For real estate firms, this standard requires identifying lease components in property contracts and recognizing them as right-of-use assets and lease liabilities. It affects financial ratios and leasing strategies, as operating leases now increase debt levels, influencing decisions about leasing versus buying properties. In real estate, construction costs such as materials, labor, and direct overheads are capitalized, as they enhance the property. Costs indirectly related to construction, like administrative expenses, are typically not capitalized. Capitalizing costs aligns with matching principles, ensuring expenses are recognized as assets until revenue generation. For Godrej Properties, accurate capitalization impacts profitability and asset valuation, reflecting true investment in development projects. Unsold inventory is recorded as an asset, typically under inventory. It's valued at the lower of cost or net realizable value, reflecting potential market adjustments. This impacts balance sheets by affecting current assets and inventory turnover ratios. Regular evaluation ensures accurate financial statements and strategic planning for sales and marketing efforts. For Godrej Properties, this requires careful monitoring of market trends to prevent overvaluation. For installment sales, revenue is recognized as payments are received, aligning with the risks and rewards transfer. This method reflects the actual economic activity and cash flow, critical for cash management in real estate. A portion of each installment covers interest, complicating revenue allocation. Godrej Properties must ensure compliance with Indian Accounting Standard 115, accounting for significant financing components, impacting their profit recognition strategies. Deferred tax liabilities arise when accounting income exceeds taxable income due to timing differences, like depreciation. Real estate firms often accelerate tax depreciation, leading to lower immediate tax payments and creating deferred tax liabilities. This reflects future tax obligations, impacting cash flow projections and financial statements. For Godrej Properties, managing these liabilities is key to optimizing tax strategies while maintaining a transparent financial position. Impairment testing involves comparing the carrying amount of an asset to its recoverable amount, the higher a fair value less costs to sell and value in use. If carrying exceeds recoverable, an impairment loss is recognized. For Godrej Properties, this ensures that asset values on the balance sheet reflect true potential, preventing overstatement. Regular testing, especially amid market fluctuations, safeguards against financial misstatements and investor misguidance. When selecting an ERP module, consider integration capabilities, scalability, and industry-specific features. For Godrej Properties, a system that supports project management, financial reporting, and compliance with standards like Indian Accounting Standard is crucial. User-friendliness and support are also important to ensure efficient implementation and operation. A suitable ERP system enhances data accuracy and process efficiency, supporting strategic decisions and competitive positioning in the real estate market. In real estate like Godrej Properties, understanding the business model is key. It involves a comprehensive project lifecycle from land acquisition to sales, with revenue from property sales and rentals. Managing costs and adhering to regulations like RERA ensures project profitability. Analysis of markets and customer relationships helps maintain competitive advantage. Additionally, sustainability practices not only enhance brand value, but also appeal to the environmentally conscious buyer. In accounting for real estate, revenue recognition occurs when control transfers to the buyer. Work-in-progress entries align costs with revenue, while land is recorded based on its intended use. Accurately tracking construction costs ensures proper financial reporting. Advance receipts are liabilities until obligations are met. Depreciation applies to operational assets, and leases are categorized for reporting. Capitalizing costs ensures that project expenses are matched with the revenue they generate. For real estate accounting interviews, demonstrate industry knowledge and financial acumen. Highlight your capability in analyzing financial statements and solving complex issues. Effective communication is key for team and client interactions. While proficiency with accounting software is expected, ethical standards are crucial, especially in real estate. Experience in project management and client orientation helps in building strong, lasting relationships with clients and stakeholders. That is your complete guide to this topic. If this video helped you, please like and share it. It genuinely helps us keep creating content like this. Drop your topic requests in the comments below. Subscribe to Candy Mentor for more finance and accounting videos.